Yeah, so obviously this is put together a little bit of a tutorial for you guys on the, my key takeaways on the class. Couple of notes. First off, if you can hold questions until the end, I'd appreciate that. It's also one thing that I really want to drive home is valuation is more mostly an art. The science is actually pretty simple. There's a few key things you got to be able to do, but most of it is about the art. There's not one size that fits all. So your expertise in knowing the case you're building it for is critical to make it useful. My competency and experience is in the energy infrastructure projects and M&A space. With energy infrastructure, they're generally very asset heavy with predictable utilization being the biggest concern, because when you have asset heavy stuff, they have a limited capacity. So it's how close you can get to capacity, and how reliable it is to get there. It's not a case where you can go and expect to, get 3 or 4 or 5 times scalability just because, or with little extra cost. Another big thing with the energy infrastructure space is that future prices are generally fairly easy to crowdsource estimates for through the forward curves. So there isn't you still are going to do scenario testing around the different commodity prices, but there isn't the same unknown to it in there. Another thing I do want to say as well, I thought that the videos that Pedro had found are pretty fantastic. I think that where I can add the most value to you guys is more focus on the actual model building. So yeah, that's going to be mine, but I'd recommend if you want more info to watch some of the videos from what Pedro sent out. So the agenda for tonight is first off going to talk a little bit about discounted cash flows, a little bit on multiples, financial statements, and then get into model building and output, interpreting it to investment thesis, and then I also have a sample model I was going to walk you all through. So first off, getting started with the discounted cash flow. At its core, what you're doing is you're trying to normalize cash flows to today so that they're comparable. And yeah, it's what it means to you today. The benefit is it makes it easier to compare projects on that basis, because you're not in your mind trying to figure out what's the difference between this year and 5 years from now. There are a couple of problems though. First off, the projection is only going to be as good as the assumptions that go into it. It's hard to predict the future, and so no model's ever right. It does also overweight large projects. Higher MPV can mean it's a better project or just that it's bigger. When analyzing groups of opportunities, if you have an unlimited budget, you want to accept all positive NPV projects. If you have a limited budget, you want to solve for the combination of projects that provide the highest MPV without exceeding your budget. With any sort of these kind of valuation techniques, you want to consider it along with everything else, not just the net present value. There might be a case where there's a smaller project that is a higher IRR, and even though you're not maxing out your budget, doing that one and saving some cash to be able to spend it tomorrow might be more beneficial as well. So that's where, like I said, this really is an art. One of the key things is obviously around cost of capital. That gets you your discount rate. The biggest one is WACC, weighted average cost of capital. We've obviously seen this in a couple of classes, but at its simplest, it's the after-tax cost of debt times the proportion of debt plus the cost of equity times the proportion of equity. When you're trying to estimate debt, there's a few common techniques that people use. One is to look at market rates of similar debt at the company with similar term. Key there is you're looking at market rates, not the list rate. If you have a 10-year bond that you're 5 years in, it doesn't matter what the interest rate was when it was first came about. What matters is what the interest rate is today. Another way to look at debt is to look at comparable businesses, and see what their debt costs are as an estimate for what a similar project or company should have, or the project or company you're looking at should have. The other side of it is the cost of equity. There's a few ways. CAPM we've seen in a couple of classes, obviously. Often as well, companies, especially larger companies or established ones, have either company-wide or hopefully division targets. Those can vary pretty dramatically between different divisions within a company. In that first case that we did in valuations, right, we talked, I don't remember what the two were, but there was, I think it was the foods business was very stable and had a lower cost of capital, or cost of equity, excuse me, than the technology division did. And then again, you can also look at similar companies as a proxy to try and estimate what your cost of equity should be. They're building a WACC calculator in Excel is fairly simple. This is an example of one you do. One of the big takeaways from this is around beta. If your beta is greater than 1, it's riskier than the market, and if it's less than 1, it's safer than the market. So that's one thing to kind of check with yourself does it make sense what the risk is relative to what you would expect for the market. It's around there. Couple of the key profitability metrics we've talked about in our classes. First off, there's a return on invested capital. This is how much you make on your average dollar invested. High ROIC companies grow fastest by increasing investment, while low companies with low margin or low metrics for ROIC grow fastest by increasing their margins. Next one is return on new invested capital. Very similar, except it's how much you're making on new dollars. The biggest thing here is that it removes sunk costs. Net operating profit after tax is the other big one. The reason you want to look at this is profitability of your business before encumbering it with any indirect expenses of the firm, because if you look at total profit, there can sometimes be some really big abnormal or unusual things that cause your cash flows to look either way better or way worse than they actually should be. Yeah. Going to some of the next ones, there's the investment rate. This is what percentage of profits you're reinvesting in the company. Your growth rate is your ROIC times your investment rate. This is something that if you are looking at companies, if they're projecting to grow faster than this, it's not sustainable and they should not be able to do that. At its core, your growth is driven by how much you're spending and what you get on every dollar you spend. Another big one is free cash flow. It's what's left over for the company after subtracting the costs of running the company. So the cash you have at the end of the day. Going into multiples, so there are estimates for fair value based on comparable firms or comparable projects. There's a couple of different types of multiples. Accounting multiples generally use cash flow multiples to judge what a fair enterprise value for the project or firm should be. One issue with accounting multiples, if you're looking at historically reported results, they're subject to management accounting choices, and as well, historical performance is not necessarily in line with expected future performance. When you go to non-accounting multiples, you start to get into industry-specific multiples for valuing, and those are generally used to try and more predict what future revenue might be, where there's a lot of uncertainty. So you might have something such as, you assume that for a biotech company, the number of patents it has is going to be really indicative of future profitability, or the active users might be a leading indicator on future revenue growth. When you're looking at multiples, it's very important that you look at comparable metrics. And so that's one of the things going through the financial statements. You're going to want to look at the notes. We'll talk about that a little bit more in a bit, but you need to adjust for things such as if one firm uses a LIFO inventory method, another uses a FIFO inventory method. Even that's purely an accounting choice. It doesn't change the underlying business. So you have to adjust for that. Going to the financial statements, this is just kind of a quick and dirty how you move along all of them. One of the big things with this is that, like I said, the notes to the financial statements are critical, not just the statements themselves, because there's a lot of management decisions that go into determining the line items on the statements. So this is an example from Alphabet's 10K form. So you can see, right, they have kind of the operating loss or income from each of their services, but then they go on to explain what's included in corporate costs. And then they keep going on to explain a little bit more about the Google services division and the other sides that you just don't get just from reading that Google services did 54, I assume that's probably $1 billion in 2020. The other big one is projecting cash flows. So for that, you're going to do free cash flow. You grab the net income from the income statement, and then you make any cash or non-cash adjustments to it. So you want to you want to add depreciation back in, because again, that's an accounting effect. It doesn't actually change the amount of cash you have. So I generally, when I'm building models, put this below the income statement. I find it's really easy to do it that way. When you get into building your model, the first thing is you got to build your base case. To come up with forecasts, there's a few different methods you can use. One is top down. With that, you're starting with the market and you're figuring out, if you could take 5% of the market, what does that mean? The other option is bottom up. Under that case, I'm going to sell 20 units for $5. Therefore, I'm making $200 in operating margin. Another option is prior sales. Last year you sold 15,000 and you think you're going to grow by 5%. And then another way that's often used for larger companies, like say a Starbucks, is to look at comparable stores. So they might look at it and say, well, our average store does this. So if I go and build another 3 stores, here's what my revenue is going to be I expect my revenue from each of them to be my average. When you're building models, generally speaking, I think it's best to do the project life if it's a specific project. If you're getting into more an overarching business, getting out much longer than 3 to 5 years doesn't add a lot of value, because it's often very hard to project what a company is going to be doing. So you're better off focusing on a shorter time frame and then just using a terminal value calculation for the ongoing business. And we'll talk about those in a minute as well. Once you have your base case, you want to do some scenario testing. So for this, the big thing is you want to decide which variables are key to your forecast and see what happens when you change them. So for example, what happens if your cost of goods sold increase 5%? And so you can use the scenario manager in Excel, or my preference is actually to build tables with the key variables. And then you can build it so that and so doing that lets you build complex what ifs where multiple things are changing. And it also helps you keep track of what the changes are. Going back to the fact that it's a art, not more so than a science, one of the biggest things is being able to test your assumptions and figure out whether or not they're accurate, or are you comfortable with them. So from this, you then want to develop both pessimistic and optimistic cases, along with the probability and some reasons for why you think each may or may not occur. If you do that, you can get quite a lot of information fairly easily just from that little table on the right. The base case, we're expecting an NPV of 75 with all the different probability weightings. It's actually probably going to be a little higher at 81. And then we can see that the expected range of outcome is from $50 to $125. Going into terminal value, there's a couple of different ways that are often used. One that works really well is the Gordon growth model. We've seen this named a number of different things. All Gordon growth is the current cash flow times the growth rate divided by the cost of capital minus the growth rate. So this assumes that the investment operates in perpetuity without any changes to the profitability. There are ways you can do it if it's a 2-stage model. So there are more complex ways that can be a little more in depth than that, but generally it does a reasonable job of estimating residual value for long-term investments. Another option is salvage value. So with this, you're going to assume that everything is sold and you walk away at the end of the day. The most common way that I've done this is you just look and assume a certain percentage of the initial purchase price you're going to get back, whether that's from stripping it from parts or selling it to Like for trucks, for example, in the trucking space, after you get the nice skirts on them to make them aerodynamic, generally speaking, the first company keeps them for about 5 years and then sells them in the secondary market. So when they're looking at purchasing new trucks, they're probably going to do a 5-year term and then assume, I don't know the number, but that they can sell it for 50% of the remaining value. The last one is you can use other multiples to do it. So perhaps you do multiples of year end's EBITDA and say that, you're going to sell it for 5 times EBITDA sort of thing. So that's another way you can do it there. You also want to look at introducing leverage and the effects of leverage. Generally speaking, you want to build your first case assuming an unlevered return. And the reason for that is because introducing debt is a business decision to best maximize the profitability. It's not actually, it's a business decision, not a project decision, if that makes sense. So companies use leverage to increase their return on equity. WACC is the weighted average cost of debt and equity. Debt should almost always be cheaper because there's less risk to debt holders than there is to equity holders that they're going to get their money back. So debt should be cheaper. Another advantage is that certainly in North America and most nations allow interest to be written off. So it actually reduces your tax burden as well. That's why in the WACC calculation, you do debt times 1 minus the tax rate. The acceptable leverage is really industry specific. Utilities, for example, often carry really high debt loads on projects. I've seen upwards of 60+%. And the reason for that is because with the rate base, as long as there's someone left on the utility system, they're going to get their money back. So it's generally not as risky. On the other hand, if you're a startup with often your leverage is very low because there's a high risk of failure and you don't have or a history of sustainable cash flows that allow you to service that debt to the same amount. So as a simplified case, if you have a WACC of 7.5% and an after-tax debt cost of 5% and 50-50 debt leverage, your equity is going to be 10%, right? 5 times 0.5 times plus 10 times 0.5 gets you to 10. And when we get into the model, I'll kind of show you how that can shift around and how it changes your WACC. A couple of simple things that I think to improve the financial model building. So first off, I really like it's the last tab you'll build, but have it at the front, an executive summary tab. This is your output reports. There's a couple of ways that you can do it. I've done some where essentially it's a print off. So after I run cases, I'll print off that and we can bring that to meetings to talk about kind of the key variables. The other one is like if you're building a PowerPoint deck, just having all the tables in one spot. So it's really simple to know where you're going to pull things from and put them in. And it makes it it makes it a really clean thing to look through when you're trying to discuss the model. The next one I like to do is a key assumptions tab. So all assumption calculation should reference it. Couple of things that this allows you to do is one, it allows consistency in your calculations. If you go and you start with a 2% inflation rate and you decide it should actually be 3%, if you got to go through every single tab, it's really easy to miss updating one. So by doing that makes it so that you just got to change one and the entire model still works. The other advantage of doing it this way is it makes it really easy to debate your assumptions. Often when I built a model, afterwards, I'll bring the output and the assumptions, say, and I assume 2% inflation, and we'll kind of go through and say, okay, these all make sense or they don't. It's really important to include all critical variables. You don't need to be right. You got to be reasonable. So for example, generally speaking, Western economies target about 2% for inflation rate. If you have a 20-year project, probably good to go with 2%. But that way, then when we find out that it's 9% this year, well, what went wrong? Well, I projected 2%, not 9%. It also often makes sense when you're projecting out longer term cash flows to use defined growth rates after a couple of years. There may be more than one growth rate in it if, for example, you have a wind down period at the end, but the farther out you get in the future, since it's harder and harder to predict, the less value there is to spending the time to really dig in and try and come up with a very specific number for the cash flow in 10 years. For complex models, I also like to color code by tab type so that I can quickly see, okay, these three are outputs. Then I have a couple of models and assumptions and however you do it that way. Then if you're building one with major and distinct divisions or product lines, I like to build separate financial statements and then a consolidated summary. The advantage of that is it lets you makes it much easier to figure out what the impact of the individual businesses is. Next up is if you're going to interpret it to the investment thesis. So there's a couple of things. Your risk appropriate hurdle rate is your WACC. Like I said, large companies often do have defined targets. Your MPV is the sum of cash flows for the project to you. If you're looking at this should be your reservation price of the most you'd be willing to pay for a project. Isn't necessarily the price you are going to pay. You then obviously need to figure out what's the market rates for it, and there's a little more that goes into it, but you shouldn't pay more than the MPV for a project or you'll destroy value. From there, you want to estimate risk and upside based on the scenario analysis. Try and estimate the BATNA for other investors and figure out, what is the market going to pay for this? Because do you have to pay up to the MPV, or what should you bid on? Then obviously that's quite a bit. There's a lot of art to going into bid strategy as well. And it's also really critical to explain key risks and assumptions. Again, things are going to go wrong. It's more important that you are aware that inflation exists than that you correctly predicted it's 2 or 9%. A couple of other tricks that I like. So first off, when you build them, spend some time formatting the spreadsheet. I've seen a lot of people who don't put any effort into this, and it makes it so much easier if you just put a little bit of time doing some basic things to make it more readable. Another thing is most people who spend a lot of time in Excel building models don't actually use their mouse. They can just use the keyboard. If you want to learn to do that, the biggest thing is just put your mouse away. To see the key commands in the Excel ribbon, you press Alt and it'll pull it up, and then you can just kind of work your way through, similar how you would, only instead of clicking a mouse, you hit H sort of thing. If you're trying to build a model and you don't know how to build a formula, ExcelJet and Mr. Excel are two sites that I find generally have pretty good formula building walkthroughs. Obviously, if you're going on the internet, there's a lot of good and bad information. So I'd be cautious about some of the things you're going to find. But if all it is you got to figure out how to build a formula, I find those sites are really effective. If you want a financial calculator on your phone, the BA Calc app is a really good one. That's the one that I use. If you're going to do it, I think the things you want to learn is know how to use the third row to manipulate the payment equation, and then use the cash flow function. If you can do those two things, most of what you are probably going to do on a financial calculator has you covered there. And then another thing that I find often people don't realize is the value of speaking in your audience's language. So if you're building your model and you guys look at it in one set of units, figure out what the conversion is and also have the output in your customers' units. So for example, in the LNG space where I've worked in a lot, as a producer, we thought in gigajoules because that's what you buy gas in and that's how they normally work. But I was doing bids for people who wanted turnkey power solutions. And so they were just looking at a per kilowatt cost, and just the simple thing of having that conversion in there makes it really simple to compare for both people, and make sure you're on the same page, and make sure that everyone can keep along with it. Yeah, so that's kind of the quick overview of that I have. Next thing, I'm going to show you guys the demonstration model. So this is a model that I built recently. It was for a interview case that I did. The information I got was pretty basic. It was one page, including the questions. They told me what the adjusted EBITDA was. They told me the project life and the capital cost. That was most of the key information that I had on it. So first off, we're looking at the dashboard of the executive summary. In this case, I was building it for a PowerPoint presentation. So I've just put some of the key tables on here and then some of the key metrics. For multiples, as I mentioned, different businesses do have different requirements. But for infrastructure, one of the biggest ones, especially if you're looking at an infrastructure investment, is just the interest coverage ratio. Most other multiples aren't. That's really the only multiple that I frequently look at doing it. Other multiples in certain cases, but that's the big one to know. So from there, I then have my assumptions tab. So how I do it, the blue ones are inputs. The orange ones are key outputs, and then just the normal white is calculations. When you're going through it, really easy to make mistakes. And so having it this way, as you just saw, I just corrected an error in my equity calculation where I had it hard coded instead of having formula, was able to look through it, very quickly change it. So going through the other thing I have on here is an explanation of all of the assumptions and where I got them from. So for debt, the higher end of comparable ranges is 10 to 50% for the comparable. So I went on the higher end of that. And for example, for the amount of debt I had, they gave me the size of the project in the case. Yeah, so you can go down through there. So to kind of show you the impact of debt on the WACC, so the project IRR in this case is effectively the WACC. So at 40% debt, the project IRR is 11.2%. If I increase it to 50%, not only did my ROE jump up because now you have more money going to a limited amount of equity, but my project IRR actually jumped to 12.8 as well. So it increased 1.6%. And again, the reason for that is because the interest portion is tax deductible, which means you're only paying, I don't remember, I think I said 23% was my corporate tax rate. So you're effectively only paying 75% of your debt, or the interest cost in this case, because you're not paying the 25% in tax. So in here, I also built two models for it. So one is kind of a quick and dirty one. Again, like I said, that I didn't have a ton of information. All I was asked was to figure out what the hurdle rate was and the price for power. So they gave me the adjusted EBITDA. I made all the adjustments to it, which gives me the free cash flow. And then the IRR is very simple. It's just the sum of all of those. And then I needed as well to figure out tax. So I built a quick little cash tax model. In this one, you see you don't actually start paying taxes until 2037. In the US, it's under MERX. So this was a 5-year MERX 5-year life. So you take your CapEx, as you can kind of see through here. My opening balance is the closing balance from the previous year. Excuse me, I have my additions, how much new capital, which is the amount of capital you put in here times the MERX rate, going through a couple there. And then I also looked at a PPA rate calculator. So for this, power purchase agreements, essentially what you do is you got to figure out what the cost per megawatt is going to be. So I have my adjusted EBITDA. I assumed some cost of goods sold and operating costs going into a higher revenue. I then had the amount of power that was produced in megawatt hours, and then it's just the 18.9. In 2024, it's the 18.9 million divided by 800,000 megawatt hours approximately, which gets me my project IRR and project ROE. The more detailed model I built went through, and I actually built out the 3 financial statements: the income statement, balance sheet, and cash flow statement. I have it, so it's actually a 20-year project. I have it just showing the first 5 years so that this would be a good printout. Going into it again, I had adjusted EBITDA. There's a whole bunch of the adjustments. So if there were any of those, that would change the EBITDA, and then built up the statement. And then I also, again, built all the way down, getting to the cash flow. And then there's a couple of those, again, the calculations I had to do at the bottom there. PPA rate calculator didn't really change much. And then I also did some scenario testing, so you can see at different levels of adjusted EBITDA, what's the IRR, what's the ROE, and what's the dollar per megawatt. Other tabs that I have in this model, I was trying to figure out the cost of debt. So what I did for this is I just went on Capital IQ, searched solar energy industry. It said, here's your comparable companies. They gave me the debt, the enterprise value. So it's very easy to figure out what the load is. They range from about 11% to 49. In this case, 32 is the average. And then they also gave me the interest expense. So from that, I could calculate the average interest rate that they paid. So I just have this in here because this way, if someone's to question the debt numbers I gave, now we can go in and have a little bit of a conversation about how it got into all of those things. So I will provide this model if people want it. I was asked to put on a couple of notes about like how this ties to the slide deck I showed. I haven't had a chance to do that yet, but once I have that done, I'll definitely send out the model to people. Yeah, so that's most of what I had prepared for it. I'm not sure if people have questions, but I can try and answer them for people now. Let me stop sharing the screen so I can see you guys. So yeah, I guess, is there any questions? Oh, there's a lot of people on here now. Ray.
Hey, Curtis, I want to tell you thank you for this presentation. It's amazing. Can you go over the bottom up versus top down? I didn't really understand that.
Okay, yeah, you're doing bottom up. What you're going to do there is you're looking at a unit basis what you're doing. So if I think I'm going to sell 10 units and then trying to figure out what the price is and going that way. So you start at a unit basis and build up to your total sales. Top down, you're going to start at an industry. So, the total market for phones is $1 billion a year. I'm Apple. And so I think that I can get 40% of that market. So, yeah. So it's just different ways. Often with financial models, you're going to want to start more on I find that the bottom up works better where you start with the unit cost, because in most cases you can do that. Where the top down would often come into play is more if you don't have as much information and like it's earlier stages and you're just trying to estimate what the size of the prize is for you. So.
Actually, sorry, one other question.
Sure.
So based on what you just said, most startups should probably do bottom up approach then.
In my opinion, most everything should do bottom up. I'm sure there's cases that that's not true, but in my experience, it would be. Yeah.
So would you say that equates to, if you have the data to do bottom up, do bottom up. Otherwise, use marketing and do top down.
Yeah, I think that's true. The other way to do it is like, there isn't necessarily only do one. You can use them to test your assumptions against each other. So for example, if you do a bottom up and you find out that you're going to sell $1 billion, and then you look at the size of the market and it's only 900 million, well, probably you're being a little aggressive in your assumptions, right? And so it's the other thing to use it for is more as the test to see if what you're thinking is reasonable. Oscar.
Thanks for putting this together, Curtis.
Hopefully it was
a lot of work, but it was easy to follow, and so thanks. So I've seen both, and I want your opinion on which one works better. If you were to do a forecast of the P&L, so I've seen it where you are essentially forecasting based off a percentage of an account. So maybe payroll is going to be a percentage of sales, et cetera, et cetera. And then I've also seen it where you're looking at payroll as a percentage change from payroll year to year. So maybe payroll in year one, looking at what it was in year two. And so you're basically forecasting what payroll is going to be in the future based off just payroll changes.
Yeah.
What are your thoughts on the two different approaches when you're doing a forecast?
I think that if you have the information, doing it how I would recommend doing it, if you can, is look at what your actual like hiring needs are. The advantage of the sales is you're assuming that you grow proportionately, right? Like you don't want to, if your sales are flat, why are you doubling the size of your company, for example, right? So doing it off of a percentage payroll increase, the issue, well, it depends on where you're doing it. If it's longer term, I've often done payroll as figuring out that, you know, we're going to need 5 people, and every year they're going to get a 2% raise, but we need the same 5 people. So from that perspective, doing the raise works. If you're trying to do and you're expecting that the number of people is going to change, I would say doing it off your sales would be a better way, or even better would be to assume, if you can, to figure out essentially cliffs where, you know, every million in sales needs 1 more person. And so when you get that extra million, then you add a person. That's a little more involved, but it's probably going to be a more accurate way for how how companies actually look at hiring decisions.
Okay, yeah, no, thanks.
Those 2 apps that you discussed for Excel, what are those exactly? Are
The
those
which,
like
sorry?
videos? The apps for, or sorry to say apps. The 2 references you made for Excel, as far as if you want to learn more, are those apps or those videos? What are those?
Oh no, those are websites.
Websites. Okay.
Yeah. So generally how I do it is just in Google, you know, how do I Google what you want to do and you know, add Mr. Excel so it shows that site. That'd be the big thing. Okay.
Thanks, Curtis.
Yeah, no problem. All right. Well, if there's